In this video, we will talk about short selling. Buying low and then selling high is not the only way to make money in the stock market. You can flip the sequence of those two moves, selling high and then buying low, also known as shorting the market. It is a risky strategy, but it is commonly used by individual investors and hedge funds to profit from a downward trending market or from overvalued assets. Shorting can have broad implications in the market, creating huge losses for some and huge gains for others. In the recent Wall Street Bets headlines, many traders are getting familiar with the term short sell and intrigued by its potential to profit from a declining stock. The process is relatively simple, so let us break it down and help you understand it. Suppose Ben wakes up one morning and believes the stock price of GameStop is grossly overvalued after he went up by 1000% in 2 weeks, and he firmly believes the stock is going to lose its significant value over the coming weeks. Ben is so convinced that he decided to short sell the stock. But how can he sell something that he doesn't already own? Ben can borrow the share that he wants to short sell from his brokerage firm. These shares may come from Ben's brokerage-owned inventory, third-party broker, or position held by you. One of the short sell requirements is to apply for a margin account, which is something you can't do with your cash account. So Ben was able to borrow 10 shares of GME stock from his broker and sell them at $400 each, pocketing $4,000 in cash minus commission and fees. Ben now has $4,000 in cash and is obligated to return the 10 shares of GME stock that he borrowed from his broker at some point in the future. Just like any other type of loan, Ben also agreed to pay interest on the X amount of share he borrowed, which will be calculated when he closed the short positions. A couple of weeks have passed. If the stock price goes down, Ben will have to pay a lower price to repurchase the share and return them to his broker. For example, if the price falls down to $200 per share, Ben can close the short position for the share he owns the brokerage by buying 10 shares at $200 each, which will cost him $2,000 in total. Remember, Ben collected $4,000 when he initiated the short positions, and he profited $2,000 after returning the shares. This is how someone profits from selling the share high and repurchase at a lower price. The primary risk of shorting a stock is that when a stock increases in value, resulting in a loss for the short positions. Short selling is a common trading technique for investors when they are convinced that the stock is more likely to fall in value than to rise. Thank you for watching. If you find this video helpful, feel free to give us a like and subscribe for more.